scheme has doubled in 5 years. I mean,
good heavens.
And you know, you've had this kind of massive increase in public servants in the past 10 years, and they've all got, I wouldn't say gold-plated pension schemes, but they're a hell of a lot more lucrative than the private sector. And they only put in a very small amount towards their pension entitlement. So it's...
Well, it's going to be interesting times in the UK.
Well, there's no such thing as a free lunch.
No, indeed. Well said. Well, thanks for that, James and Jeff. Some pretty hot topics, which I'm sure we'll hear more about in the coming days. Up next, we ask our guests, where to from here? Welcome back. Well, another good, lively discussion in today's episode. A couple of points of interest to me. We were talking about the UK economy, and you mentioned, Jeff, that economy in the last probably decade has become too reliant on the financial services sector, with these vast sums of money floating around and being loaned out, and with England living beyond its means, basically. Is there a parallel there, though, with eggs and baskets in terms of Australia? Perhaps they're putting all their eggs too much into the mining basket.
Absolutely. I mean, I've got a brother who's actually working as a fireman on an offshore oil rig and natural gas platform, and you know, he's attracted by the higher money. And
this is off Australia.
Yeah, and you've got New Zealanders going over there attracted by the higher money. You've got people who might have been working in a shop in Perth who decide that they can go and drive a truck in Karratha and earn 120 grand a year. So you get distortions in the market, and what it's done is, you know, obviously the commodity boom has pushed up the exchange rate, the Australian dollar, and which makes the manufacturing and the ag sector, you know, for exporting difficult. And if you suddenly went back to where we were 10 or 12 years ago when the commodity boom wasn't booming, there's a danger you become over-reliant on one sector. And again, we've had this discussion last time about the extra tax on mining. At the moment, probably miners can get away with it, but if we go into a downturn through an economic cycle, then you're over-reliant on one sector. And I mean, at the moment, it's exporting to China.
Indeed. Now, James, I'd like to go back to the sectors. We had to skip over the dairy outlook at the moment. How is that looking? Are we going to be getting used to these fairly comfortable price levels?
Yeah, I mean, prices are stable at the moment. It's a good thing, I guess, in global terms. I mean, I've been a little bit cautious about prices for a while now. One being some factors coming out of the US with production increases, and we're starting to see the herd increase and production increase, and feed costs are down, and that's all, you know, good promotion for a bit more milk into the vat in the US, and that's a risk to international markets. The other factor's been what's happening in Europe and a bit of a slowdown in China, and those second two factors do seem to have drifted off a little bit at the moment. There's, you know, the European situation is not as significant in the marketplace at the moment. We've also the stories coming out of China is good too. So I think all these things are quite positive for dairy markets. You know, I'm a little bit reluctant to say that we're going to continue to see prices at current levels for forever. But you know, in terms of you know, future payouts, then they're looking positive. And for us, then, you know, we've been sort of picking a payout for next year upwards into the late $6 range, and it looks like the risks do lie to the upside of that at the moment. And very briefly, forestry is a one we often skip over, but it's actually doing very well at the moment, isn't it? Yeah, exceptionally well. It's forestry's gone through a great couple of the last quarter, really, probably through the first part of 2010, and being driven out of China again. We keep on coming back to China, but you know, they've been sort of suffering under some tax changes or tariff changes from Russia, and that's affected what they can bring in from Russia, and it's fueled demand for us. And of course, you know, earthquake in Chile disrupts supply out of that area of the world. So, you know, all looks quite good for forestry. You know, if not for Chile. Yeah. Now, just very briefly, James, what's in store over the next week? Any predictions?
GDP
is the big one, I guess, over the next day, and
that's for the March quarter, isn't it?
That's for the March quarter. We're predicting 0.5% increase for the economy, and if we do see an increase in that, then it's going to be positive for the economy, and investors will see New Zealand as being a good place to invest, and we might see a bit of an uptick in the dollar.
And Jeff, anything in the wind from your point of view?
Well, not over the next week, but certainly in the next month. I mean, we're only a week, 10 days to the end of the month. Probably about the 10th of July, you'll start to see second quarter profit figures coming through from some of the US corporates. So we'll get a flavour for, how their economy is ticking along. And then obviously we're going to get another rate rise at the end of July.
Yeah.
So those are the things, to look for.
Indeed. Another 0.25%.
Yep.
Yeah. Well, that's all we've got time for today, unfortunately, but thanks to my guests, rural economist James Shortall from the ASB and Spicer's financial advisor, Jeff Matthews. Well, we'd love to hear your feedback, so please go to our website and drop us a line and check out my weekly blog. We'll see you next week. Ka kite anō.